This is the Daily Market Rundown live from the Tradelo Trading floor. It's November the 7th and some highlights from today's show. We're going to talk US election results, gold correction is in play, and Bitcoin is breaking to record highs. Good day traders, let's start and talk a little bit about some of the overnight news. It's all about Germany. They've called, or we've had a breakdown in the coalition there, which very much leans towards this idea of a snap election. Now, why does this matter? Well, look, Germany has been weak, not just this year, but last year. Germany is battling to grow. Germany is the biggest economy in Europe. The reality is they keep facing a number of different problems, and this is not exactly going to solve them. Now, do keep in mind we've obviously had quite a lot of movement in particularly the euro over the last 24 hours, but this adds just to more concerns facing the euro, more headwinds. We do see an ECB that currently is a little bit concerned about the growth trajectory, and this is not going to add anything positive to that. So that's something to watch very, very closely, and the ECB will of course be paying close attention to that as a key risk for them. Now, we turn our attention, of course, also to China. Overnight, we've had some news about effectively a ramp up in exports from China. And this makes absolute sense given that Donald Trump has now won the election and is set to impose some significant tariffs on China. So the thinking is we're going to see a ramp up in exports from China. Why does this matter? Well, we might see some very interesting data coming out of China over the next 2 months. We do know that exports has been one of the green shoots for the Chinese economy. So don't be surprised to see some really, really strong numbers, but these will fizzle out, of course, as we move into the start of next year. Now, let's go and take a look at one or two very, very interesting charts in terms of the news. And this is just a summary of where we are now in terms of the election. It's not over yet. There's obviously one key risk that's still outstanding, and that's the House. Whilst the probability very much leans towards the Republicans for this clean sweep, it's of course a risk. If something dramatically changes for whatever reason, there is of course a risk that they don't win the House. But again, like I said, a very, very unlikely event, but just be aware of it's not done yet. We still have ongoing counting going on there. But look, Donald Trump has won the election in terms of the electorate. He's, it's 295 versus 226. And I think this matters because what it tells us is that the electorate has sent a very strong message, a change message. They want a Donald Trump mandate. People are just fed up, and I think that's the key takeaway from this election. People want change. Okay, now what that means is that you're not going to see Donald Trump come out and not deliver on his policies, and I think that's what the market is getting ahead of. They really are leaning on this idea that, well, he's going to come out, he's going to put those tariffs in place, he's going to be very strong on immigration, he's going to do a number of different things in terms of tax relaxation. But the key thing I want to stress at this point is that he doesn't come into power until January, number one. It will take time for him to, of course, make a number of hires and get back into the White House. So it could well be at least 6 months before we see any real kind of policy measures put into place. Okay, so one thing is, obviously we do have time now where the markets are going to digest a Donald Trump presidency, but we do need to actually wait for those bills and those policies to come into play to really start to understand the impact of some of his policy measures. Now, Nomura has come out overnight, and I think this is an interesting one. This is from Bloomberg, and Nomura is talking about under a Trump presidency, they think that inflation for next year, so 2025, will be around 75 basis points higher. Now, if we look at the dot plot from the Fed that came out in September, they were talking about average inflation for next year around 2.1% via the PCE. So this really does serve a conundrum for the Fed. The reality is the Fed is forecasting 4 rate cuts next year. Now, if inflation is going to be 75 basis points higher next year, there's absolutely no way that they are going to be able to cut 4 times next year. And what Nomura is leaning on is we are very much going to get one more final cut at the start of next year, and that's it. So keep a very close eye. This is the kind of analysis that is taking place on a number of desks at this point in time, and these plays will be put on at some point into the next couple of months. So just keep a close eye on this. Now, of course, like I said, the devil will be in the detail. We'll actually need to see what Donald Trump does at a policy level before we can start to see some certainty on these forecasts. Now, there are some key markets to pay attention to, and this is what we're going to go through now. I think the first one that had some serious implications for the Donald Trump presidency is gold. Okay, now yes, he is going to be inflationary, but by and large, gold has been on a rip higher all year on inflationary hedging. Okay, it is just the number one shining market this year. It's been bid up all year. And I think it is that market that will continue to rise. It'll continue to rally. How high it goes, okay, that's anyone's guess. But the key thing I want you to take away from this chart is two things. Number one, we have had very shallow corrections all year. Okay, the deepest correction we had all year was around 6.5%. It lasted 3 weeks. So call it just shy of a month. Okay, we had another correction sort of in October when we made new record highs. That was around 3%, and we've just had our third correction in this rally of around 5%. Okay, the point is that the corrections in gold all year have been shallow, and that's not likely to change. Okay, the thesis for gold is very much driven by this concern of higher inflation, and like I said, if there's any inkling that inflation expectations are going to rise in the US next year, they're going to be a lot higher than what the Fed thinks, there's absolutely no way that the gold thesis is going to break anytime soon. Okay, and again, that is why Druckenmiller, Paul Tudor Jones is coming out and saying the only way is up for gold. Okay, it will continue to remain a gold, an inflation hedge, and that does mean we should be back at those record highs perhaps at some point again in the next couple of days and weeks. Okay, keep a close eye on that. That is quite a fascinating market. Now let's go and take a look quickly and talk about some of the overnight market moves. I think there's a couple of very interesting things to pay attention to. VIX got squashed yesterday. The MOVE index got squashed, and what that tells us, of course, is that equities now at record highs is somewhat justified. If there's no fear or risk currently, it means that at record highs we will see a lot of those momentum strategies put into play, and we should just see that S&P move its way back toward, or not back towards, but up towards 6,000 and perhaps beyond into year end. Now, a few other markets to pay attention to. I think Tesla yesterday was one of the standout ones, and again, we're up 15 and a bit percent this week. What is that driven by? Well, okay, yeah, perhaps there's some thought that Trump presidency will only prove positive for Tesla in terms of subsidies, in terms of sort of more support for that in terms of the economy. But the reality is that Tesla was one of the standout winners from that. We obviously saw Trump media up a significant amount yesterday, quite a lot of volatility there. Some of the other markets, I think dollar was a key one yesterday. It was significantly bid up the page, as well as in general. I think the tech stocks did very, very well yesterday. Okay, one key thing to pay attention to, of course, is that a Donald Trump presidency was very, very bad for emerging markets in general, because of course he was inflationary. That meant higher yields, and that meant a very strong dollar. Okay, strong dollar environment's always going to be problematic for emerging markets. So that is one to be very closely attentive over the course of the next coming weeks and months. Okay, let's now turn our attention and go and have a look at some other interesting charts that we definitely want to be paying attention to. And the first one is, of course, Bitcoin. It's at record highs. And if we go and take a look at the technical analysis, we can see we've broken out now. We've been in this, call it whatever you want, just a consolidation pattern, some sort of a trend channel for the entire year. Okay, we rallied at the start of the year. We then went into this channeling process where the market was bought up on the lows and it was sold off on the highs. We rarely battled around that 72,000. We tried there once, twice, 3 times, 4 times. Market just couldn't reclaim those levels. And we now consolidated just ahead of those 72,000s. We snapped above it, again failed. But now we have not just broken above that 72,000, we've closed above it for the first time in sort of some time. We've also closed up at record highs for the first time, and what this means is this Bitcoin market now has gone into price discovery mode. It's had a consolidation close at record highs, and that really does sort of give the green light for again those momentum plays to come back into the market. We should see a number of trend following momentum strategies now deployed into Bitcoin. We should see volume stay elevated. We should say volatility or implied vol stay elevated. And ultimately, this market has got open skies to the upside. Okay, there is no real logical reason to be short of this market. Of course, that can change, but the reality is right now, with equities at record highs, with the VIX being squashed, it just really points to a scenario where Bitcoin should just continue to rotate higher. And again, how high it goes, that really depends on ultimately, who's going to be willing to sell it and why they would sell it. What's the logic behind giving liquidity to the market in price discovery mode? So I think you have to just go back and look at 2020. Oh, I had a chart of 2020. Ah, there it is. No, one sec. Oh, okay, I've lost the chart of 2020. But if we go back and look at the 2020 Bitcoin, what you would have noticed, I'll annotate it for you. We kind of got towards 20,000, okay? We then sat and consolidated just below it, right? Similar kind of thing. Market consolidated all year below that record highs. We then snapped through it. We did a 24% rally, and again, then the market consolidated. Okay, something similar. We've snapped through it. I wouldn't be surprised to see a little bit of consolidation here, and then, of course, the continuation move to the upside. The point is, so long as we keep closing above 74,000 in Bitcoin, it's those closes that are ultimately going to be very positive for the bulls. So again, another close above 74,000 today, it just adds to the probability that we are going to explode higher. Now, a very, very interesting chart, and it's one you got to pay attention to, not perhaps today, but one you do need to be very switched on. Now, there's this, if you often talk to pit traders, they'll always tell you, oh, the 30-year bond, that's the one we always followed and tracked. And there's definitely some merit in that for the simple reason that long bonds never move, okay? And so if they do move, you have to be very aware of it, very switched on to it, because keep in mind, particularly in the United States, everything is hedged against the long bonds. Okay, think of everyone that's mortgaged in the US. They mortgage themselves against 30-year bonds. So when those yields do move, it is showing very structural shifts, okay, cyclical type trends. These are not things that are easily moved. So if they are moving, if they are breaking, it's telling you that there is a significant trend underway and you've got to be switched on and alert to it. Now, what I've done in the orange, you got 30-year yields. You can see that 30-year yields have risen since COVID era. We topped out around that 5.2%. We backed off all the way down to 4%. Okay, but I've also added the green line there because the green line is in essence giving us a 200-day average. And what we can see is that the 200-day average for almost all of this year has been around that 440 mark. Okay, it's not really moved over the course of this year. It is very much stuck around that 4.4%. Okay. So what I want to illustrate here is that 30-year yields have been contained within 4 to 5% all year. They're not breaking out. They are just contained. But at some point, if Trump is going to prove to be inflationary, if there is going to be concern around the fiscal situation in the United States, what you're going to need to see is you're going to need to see, one, this 30-year yield move back up to 5%. But more importantly, you're going to need to see that green line start to move higher. If that happens, yes, there are significant implications for a number of markets. And the key one is the one I've got in purple here. It's equities. Okay, equities will continue to rally on this idea that there is significant growth in the United States and there just isn't a high level of yield to restrict that growth. You put 30 years above 5%, that game changes quite dramatically and quite quickly. Okay, so just be very, very switched on to this chart. Not today, not tomorrow, not for the next week, but definitely for the next year. Okay, 30-year yields get above that 5%, you'll start to see a little bit of concern, a little bit of panic in a number of different markets, and that may be the risk-off scenario that at some point we can capitalize on in 2020. Okay, in terms then today of, in terms of what we've got, we've of course got the BOE out shortly. They're expected to cut 25 and keep the door open to another cut in December. We do of course also have the key event for today, which is the FOMC out later on today. If you didn't watch that rundown, you will find that link on our YouTube channel. So go and watch the rundown or the preview for the FOMC meeting today. And of course, that will be a very interesting one. What I would say is, with regards to this meeting, I suspect it's going to be one of those where, there's a lot of traders out there that are still filled with adrenaline. They still sort of blood pumping post the election results. So they're going to be looking for work to do, when in reality, Powell's going to be looking to get out of there as quick as possible. Okay. The reality is he doesn't really want to say too much. He said what he needs to say, which is we're cutting. We're going to continue cutting because we've got room to cut. Okay, so don't overthink tonight's FOMC. It's one of those where I suspect markets will pretty much trade back to where they were once the meeting settles, and we will see sort of a bit of a damn squib type meeting. Okay, of course we do prepare for all scenarios, and that's what that preview's for. But most importantly, just keep in mind that we've done a lot this week. Markets are very out of balance, so don't get sucked into thinking something's been said simply because the markets are just moving within these volatile ranges. Okay, that's it for today then. Good luck out there. Always manage that risk, and of course, go make some money.